A massive, historic spike in oil prices is flashing a major recession warning, putting the entire global economy on edge. According to Ben Cowen, this isn't just about the price at the pump. It's a classic late-cycle signal that traps the Federal Reserve, making a hard economic landing much more likely. This macro pressure is now spilling directly into our markets. Jebb connects the dots, arguing this exact energy crisis will drag down stocks, and historically, Bitcoin almost always follows. He's sticking to his prediction of a drop below $60,000, targeting the 200-week moving average. The on-chain data seems to support this caution. CryptoRover points to a chilling chart pattern that mirrors the 2022 bear market structure, highlighting a massive pool of liquidation liquidity sitting right between $61,000 and $62,000. But the immediate battle is at one key level. DataDash calls $71,000 the ultimate test. If it fails to hold, he warns a failed auction could send the price tumbling back towards $59,000. So which signal will win out?
In the latest video from the Ben Cowen channel, the discussion centers on a massive, historic rally in oil prices, which jumped from $67 to over $91 in just 1 week. This isn't just about the price itself, but the rapid rate of change, which is a concerning signal for the economy. The video explains that we're in a late business cycle environment, and historically, spikes in oil often precede recessions by putting pressure on an already weak economy. This event threatens the soft landing the Fed has been aiming for. The problem is, the Fed is in a tough spot. Even with some weak labor market data, they can't easily cut interest rates because the oil spike raises serious inflation fears. This delay could cause them to be too late, potentially triggering a hard landing. The S&P 500 has been stagnant for months, which is another warning sign. The video draws a parallel to when Bitcoin's price stalled before a major correction. We're now watching to see if this combination of a weak stock market and spiking oil will start a negative feedback loop of company layoffs, which would officially mark the beginning of the end of the current business cycle. Ben Cowen's analysis of the oil spike as a potential catalyst for the end of the business cycle is particularly timely. As of early March 2026, the situation has been amplified by significant geopolitical tensions in the Middle East, which have pushed WTI crude futures above $90 a barrel. This external shock complicates the Federal Reserve's position, just as the video suggested. Recent data shows the U.S. unexpectedly lost 92,000 jobs in February, and the unemployment rate ticked up to 4.4%, adding weight to the argument that the economy is weakening. However, inflation remains a concern, with the latest CPI data showing it's still above the Fed's target. This creates the exact dilemma Cowen described. The Fed is caught between a slowing labor market and resurgent inflation fears, fueled by energy prices. While some analysts still project interest rate cuts later in 2026, the oil situation makes the timing and magnitude of these cuts highly uncertain, increasing the risk of the hard landing scenario.
In the latest video from Jebb channel, he breaks down why the recent conflict in Iran is spelling trouble for the markets. A massive spike in crude oil prices is happening because a huge chunk of the world's energy exports from the Middle East are suddenly offline. This disruption is creating an energy crisis that's starting to drag down the U.S. stock market, which was already looking a bit shaky. The core argument is that, historically, when the stock market takes a nosedive, Bitcoin almost always follows suit. He points to past events like the crash during the Ukraine war as a playbook for what's happening now. The idea that Bitcoin can start a new bull run in the middle of a major energy crisis seems unlikely. He's sticking to his prediction that Bitcoin will fall below $60,000 and eventually touch its 200-week moving average. While he thinks buying Bitcoin around $68,000 is a great long-term move, he stresses the importance of keeping cash ready for potentially even better prices if this correction plays out as expected. The video's thesis hinges on a classic risk-off chain reaction. Geopolitical conflict sparks an energy crisis, which then pulls down equities, and, by extension, Bitcoin. Recent events certainly support the initial steps of this argument.
According to Forbes and Bloomberg, the conflict in Iran has caused an immediate spike in oil prices, with WTI crude jumping from around $67 to nearly $91. This has injected significant volatility into the stock market. However, the link between equities and Bitcoin is becoming more complex. While the 30-day correlation between Bitcoin and the S&P 500 has recently hovered around 0.55, showing they often move in tandem, this isn't the whole story. Research from NYDIG suggests that stock market movements only account for about 25% of Bitcoin's price changes, with crypto-specific factors like ETF flows and regulatory news playing a much larger role. In fact, following the initial shock of the Iran conflict, some reports indicate that crypto weathered the storm better than other risk assets, with spot Bitcoin ETFs attracting over $1 billion in net inflows in the days following. While the macroeconomic headwinds from an energy crisis are undeniable and could pressure all assets, the crypto market's internal dynamics, such as the recent massive deleveraging event mentioned by investing.com, might have a more immediate and profound impact on its direction than its correlation to the S&P 500.
In the latest video from the CryptoRover channel, the discussion centers on a striking resemblance between Bitcoin's current chart and the pattern seen during the 2022 bear market. The analysis points to a sequence of events, a parallel channel breakdown, a significant wick on the following weekly candle, a few weeks of consolidation, and a failed push higher that mirrors the previous cycle. This historical parallel suggests Bitcoin might show more weakness before any significant upward movement. The speaker is holding off on opening new long positions, hoping for an opportunity to enter at a more favorable price. A look at the liquidation heat map reveals a concentration of liquidity between $61,000 and $62,000, which could be a near-term target. The video also highlights a trading range, where a recent breakout to the upside turned out to be a fake-out, strengthening the case for a retest of the range's lower boundary around $62,000 to $63,000. Potential long-term accumulation zones are identified between $54,000 and $57,000, with a more aggressive entry point eyed below $50,000. Despite the short-term caution, a daily dollar-cost averaging strategy is in place for any price below $74,000. The summary also touches on macroeconomic factors like rising oil prices that could introduce further uncertainty and downward pressure on Bitcoin's price. The video's technical analysis, which draws parallels to the 2022 bear market, taps into a cautious sentiment currently prevalent in the market. Many analysts in early March 2026 are pointing to key support and resistance levels, with a breakdown below the low $60,000 potentially opening the door to the $50,000, which aligns with the speaker's outlook. However, the narrative is split. While some technical setups like bear flag suggest downside risk, others see the current consolidation as a potential accumulation phase before a move higher, especially with institutional interest providing a floor. The speaker's focus on macro factors is particularly relevant. The Federal Reserve's upcoming interest rate decision on March 18th is highlighted by multiple sources as a major catalyst that could sway the market. Any hawkish signals could reinforce the bearish case presented in the video. The analysis of liquidation levels around $61,000 to $62,000 is a sound, data-driven approach, reflecting where market mechanics could pull the price in the short term. The broader context includes a market wrestling with geopolitical tensions and waiting for clearer regulatory signals, which adds weight to the video's cautious but opportunistic stance.
In the latest video from DataDash, the focus is squarely on Bitcoin's dance around the critical $71,000 mark. After a $10,000 surge in just a few days, all eyes are on this level, which could decide the market's direction for the coming weeks. The idea is that if Bitcoin can secure a daily close above $71,000 and hold it on a retest, we could be looking at a significant push higher, maybe even back into the $85,000 to $90,000 territory. However, there's a flip side. If the price breaks above this level only to fall back below it, that's what's called a failed auction, and it's a very bearish signal. Such a move would likely send Bitcoin tumbling back down to the range lows around $59,000. It's a classic if-then situation.
Adding another layer, there's a similar pattern playing out with MicroStrategy at its own key level of $141. If both Bitcoin and MicroStrategy hold their ground, it strengthens the case for a broader market move to the upside. The video also briefly touches on gold, noting that $5,029 is its immediate line in the sand. Losing that could open up a path to $4,700. The analysis from March 5th pinpointed $71,000 as Bitcoin's make-or-break level, and the market has since responded with notable indecision. As of March 8th, Bitcoin has struggled to maintain momentum, dropping below $67,000 after failing to hold higher ground. This aligns with the video's failed auction scenario, where a failure to establish support could precede a move down. The broader market sentiment reflects this, with the crypto fear and greed index hovering in the extreme fear zone, indicating widespread anxiety among investors. Recent analysis confirms that the crypto market is in a consolidation phase, stuck between key support around $60,600 and resistance near $71,300. The lack of a clear directional trend is evident, with Bitcoin showing relative stability compared to altcoins, many of which are displaying more significant weakness. MicroStrategy, MSTR, has also shown volatility, reacting to its own Bitcoin-backed strategy amid fresh equity issuance. This suggests the high correlation noted in the video remains a key factor. For now, the market seems to be validating the video's premise. The battle for these key levels is indeed paving the way for the next major move.
After breaking down 4 different perspectives, a powerful consensus emerges. The market is on high alert. Nearly every analyst agrees that the historic spike in oil prices is a severe macroeconomic threat, creating downward pressure on all risk assets, including Bitcoin. The consensus points toward an imminent test of lower prices. The key divergence lies in the primary driver. Is this a broad recession-driven sell-off or a more isolated technical breakdown at a key level like $71,000? The ultimate question is whether crypto-native factors can offer any resilience. Your key takeaway? Macro and technicals are aligned on risk, so brace for volatility.